Welcome back to our channel, where we help you make mindful financial decisions. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an update. Today, we're diving into a hot topic, navigating the tariff storm. With Trump's trade war shaking up the markets, it's crucial to stay calm and make smart investment choices. Let's get started. First things first, let's talk about market volatility. Seeing the stock market fluctuate can be scary, but remember, volatility is a normal part of investing. Historically, markets have always recovered from dips caused by geopolitical events. Take the 2008 financial crisis, for example. The market took a hit, but it bounced back stronger than ever. The key is to stay informed and make rational decisions. But why does the market react so strongly to events like tariffs? It's all about uncertainty. Investors hate uncertainty because it makes it hard to predict future earnings. When tariffs are announced, companies might face higher costs, which can eat into their profits. This uncertainty leads to sell-offs, which in turn causes market volatility. Understanding this can help you stay calm and make better decisions. Now let's talk about your investment horizon and risk appetite. Your investment timeline, whether you're in it for the short term or the long haul, should guide your decisions. If you're a young investor with decades ahead of you, you can afford to take more risks. But if you're nearing retirement, you might want to play it safer. Risk appetite is about how much uncertainty you're comfortable with. If you're the kind of person who checks their investment portfolio daily and panics at every dip, you might have a lower risk appetite. That's okay. It's important to know yourself and invest accordingly. On the other hand, if you're comfortable with the ups and downs of the market, you might have a higher risk appetite. There are tools online that can help you assess your risk tolerance. These questionnaires ask about your investment goals, time horizon, and how you react to market fluctuations. The results can give you a better idea of how much risk you should take on. Your age also plays a big role in your investment strategy. If you're in your 20s or 30s, consider a more aggressive approach focused on growth. Stocks, ETFs, and even some riskier assets can pay off big in the long run. You have time on your side so you can ride out market fluctuations. If you're in your 40s or 50s, you're in the accumulation phase of your investment journey. You should aim for a balanced portfolio with a mix of stocks, bonds, and other assets. This way, you can still benefit from market growth while protecting your investments from major downturns. And if you're retired or nearing retirement, focus on preserving your capital with safer investments like bonds and savings accounts. At this stage, it's more about generating income and maintaining your lifestyle than chasing high returns. Diversification is your best friend in uncertain times. Spread your investments across different asset classes to minimize risk. Stocks can offer high returns but come with higher risk. Consider investing in a mix of large cap, mid cap, and small cap stocks across various sectors. This way, if one sector takes a hit, your entire portfolio won't suffer. Bonds provide stability and income. They're a great way to preserve capital and generate steady returns. Consider government bonds, corporate bonds, and even municipal bonds. Each has its own risk and return profile, so do your research. And don't forget about savings. Having a cash reserve is crucial. Aim to have at least 3 to 6 months worth of living expenses in a high-yield savings account. This can protect you from having to sell investments at a loss during market downturns. Alternative investments like real estate or gold can act as a hedge against market volatility. Real estate can provide rental income and appreciate over time, while gold tends to hold its value during economic uncertainty. Finally, consider international investments. Diversifying globally can protect your portfolio from risks specific to one country or region. Emerging markets, in particular, can offer high growth potential, but they come with higher risk. If you're new to investing, welcome. Now is a great time to start, but be smart about it. Avoid the temptation to go all in during a market dip. Instead, use dollar-cost averaging. Invest fixed amounts regularly to smooth out the effects of market fluctuations. This strategy can help you avoid the pitfalls of market timing and reduce the impact of volatility on your portfolio. Another strategy is to start with index funds, or ETFs. These funds track a specific market index and offer instant diversification. They're a great way to get exposure to a broad range of stocks or bonds with a single investment. Plus, they typically have lower fees than actively managed funds. And most importantly, educate yourself. The more you know, the better decisions you'll make. Read books, attend seminars, and follow financial news. There are plenty of resources out there to help you learn about investing. One of the biggest challenges investors face is managing their emotions. It's easy to get caught up in the hype and make impulsive decisions based on fear or greed, but emotional investing can lead to costly mistakes. FOMO, or the fear of missing out, is a common trap. When you see others making big gains, it's tempting to jump on the bandwagon, but chasing hot stocks or trends can backfire. By the time you hear about a hot investment, it's often too late to profit from it. Stick to your investment plan, and don't let FOMO drive your decisions. On the other hand, fear can also lead to poor decisions. When the market dips, it's natural to feel anxious, but selling during a downturn can lock in losses and miss out on the eventual recovery. Stay disciplined and remember your long-term goals. Staying informed is key. Keep an eye on economic news and market trends, but don't let the headlines scare you into making impulsive decisions. Regularly review and adjust your investment strategy as needed. Remember, the goal is to stay calm and make mindful choices. Consider setting up a system to stay informed without being overwhelmed. Follow a few trusted financial news sources, set up alerts for major events, and schedule regular portfolio reviews. This way, you can stay on top of things without getting caught up in the daily noise. And that's a wrap. Today we talked about navigating the tariff storm and protecting your finances. We covered market volatility, investment horizons, risk appetite, age-based strategies, diversification, tips for new investors, emotional investing, and staying informed. Remember to stay calm, diversify your portfolio, and make decisions based on your investment horizon and risk appetite. If you found this video helpful, give it a thumbs up and share it with your friends. Don't forget to subscribe for more mindful financial advice. Thanks for watching, and see you next time.